Hi, this is Vlad and today I'd like to discuss current market conditions. It seems like there are diabolical forces in the market. On one hand, you have a quantitative easing, and at what point the Federal Market Committee will start increasing the rate. That's on one side. On the other side, you have current economic news and how quickly will the economy recover and what is the current unemployment rate. So we had two announcements, one on Friday where unemployment rate were very low, but the number of jobs created in the market was very low, and there was dismal numbers by any stretch of imagination. But the market held on pretty well because everybody was hoping that because the economy is creating few jobs, the Federal Market Committee will increase the rate at a slower pace. So with that hope, the market held on pretty well. And that happened on Friday. On Monday, we started, we're just in the beginning of the earnings seasons, and we started with a few earnings announcements, and the market went down because people were afraid that the economy will not recover at the fast pace. So based on the current market condition, based on the earnings seasons, we've seen that JP Morgan today beat expectations on the revenue, and on Friday, Alcoa missed the earnings. So it seems like the S&P is currently stuck in a range between the 1800 and 1850. And it's very important at this market condition to make sure that your portfolio is protected. And one way to protect your portfolio in the sideways markets where you have these diabolical forces is to trade options. So people who are new to options sometimes are afraid to trade them because they're very complicated. But in reality, you can think of options as insurance. So you can buy insurance on your house if in case you think that the stock is going to go down, or you can rent your house to earn extra income. So the options is just that, it's an insurance. So if you want to protect your portfolio on the downside, you can buy puts. And there are different attributes or factors that drive the price of the underlying options. And you want to buy puts that are at the money or near the money. You want to look at the probability of the put to make you money or protect your portfolio at a certain time range. So you want to buy at the money or near the money puts because the probability of these puts being at the money is higher. If you buy options that are out of the money, the probability of them to bring you any protection or hedge of your portfolio is very small. So I'd like to start the series by discussing different factors, and one of them is delta, which is highly correlated to probability of a stock being at a certain price at a certain time frame. So if you want to protect your portfolio with puts, you buy them at the money with the high delta. And that allows you to protect your portfolio in case we are in this range, S&P is in the range, and stocks move on the downside. On the upside, if you want to protect your portfolio but not lose your underlying stocks, you want to sell the options that are out of the money. It will bring you extra income when they expire worthless, and the probability of these options being at the money where your stock gets called away is very low. So the tip of the day is to use your options. You want to learn what the delta is. Delta basically shows for each dollar movement of underlying stock how much the price of the options will move. So you want to, if you're buying options long, such as put, you want it to have a high delta at the money or near the money. But if you want to sell the options for extra income on a monthly or quarterly basis, then I would recommend selling out of the money options with low delta and low probability of reaching its level, stock reaching that strike level at a certain price. And again, for further stock analysis or probabilities, you can visit tradespoon.com. And this is Vlad. Thanks a lot.